If your portfolio is expensive and concentrated, you should address those problems, as we know that historically, it's just not a great place to be.
So do you think about mega cap growth as a upside down triangle? There's a chance it might stand still, but what's more likely to happen? It's likely it's just going to tip over.
Hello, everyone. Welcome back to the Alpha Architect YouTube channel. Today, we want to talk about something that's been on top of mind for many investors and advisors alike. And that is this feeling that the S&P 500 may be overly concentrated and overly expensive. Well, guess what? It's not just a feeling. It's not just in your head. It's in the data. Before we get into the weeds, I want to introduce our panel for today. With us, we have Jack Vogel, co-CIO, and Ryan Kirlin, president of Alpha Architect. Welcome back, gents.
How's it going?
So let's talk about how the S&P 500 is positioned today. Well, first talk about concentration. Where are we at? Well, as of the day of writing, the top 10 names in the S&P 500 currently make up over 35% of the index. And it's the most concentrated that it's been in over a century. And historically, concentration can be either really good news or not so good news. It really just depends on what it's likely to happen going forward. So in the Morgan Stanley paper, Stock Market Concentration, How Much is Too Much, the authors find that historically, during periods when concentration is rising, returns tend to be above average. However, if concentration is falling, returns tend to be below average. And I think this should make sense. I mean, if you're market cap weighting, you will have an outsized exposure to larger stocks. And if these stocks are growing at a higher rate than the rest of the market, then you're likely going to benefit from this rising concentration. However, if these mega cap stocks were to bleed and concentration starts falling, then it should mean that your largest holdings are losing at a pace faster than the rest of the market. Now, looking at this chart from the paper, it's likely that you would have wanted to own stocks in the 90s when concentration was rising, but might have opted to be in a different asset class, such as international stocks or maybe even value stocks when concentration was falling. Now, one of the interesting facts is that market concentration is not only rising and it's getting close to all-time highs, but that it's rising at one of the fastest rates we've ever seen. So for indexing to continue to have outsized returns as it has in the past, one should hope for even higher concentration. But if history has anything to say, it's likely that if the market was to fall in concentration, then one would want to look at some alternatives or complements in order to diversify away from this concentration. That's one topic. The market is pretty concentrated. But let's look at a second concern, and that is that the market is pretty expensive. Jack, what do valuations have to say about how the S&P is likely to behave in the future?
Yeah, that's a good question. So if we go back to the chart we showed earlier, it's not just that the S&P 500 is concentrated, but that the average PE ratio of the top 10 holdings is 48. That's actually pretty expensive, right? So a natural question one could ask is the following. Can valuations tell us anything about future expected returns? And it turns out that although valuations are not a perfect forecasting tool, they can still tell us a lot. So in this next chart, we have plotted the Shiller-CAPE ratio for the US market over the past 34 years and compared it to the forward 10-year compound annual growth rate, or CAGR. Now, for those who don't know what the CAPE ratio is, it basically is a popular valuation metric for the market as a whole that attempts to control for economic cycles. Now, in this chart for any given period, we're looking at what the S&P returned for the next 10 years alongside the CAPE ratio. Clearly, there seems to be a relationship between valuations and forward returns. Cheap markets tended to yield strong forward returns, while expensive markets tended to signal lower expected returns in the future. In fact, as of the end of Q3 2024, the Shiller-CAPE is at a value of 35.8. And the last time the S&P was at a reading that high, toward the end of the dot-com bubble, the US market went on to compound at 1.3% per year for the next 10 years. Now, while there are some legitimate reasons for the current K value to be higher today than it was in the past, and we're not necessarily saying that those will be the returns going forward, there is some strong historical evidence supporting the idea that valuations tend to weigh on returns in the future. In other words, when markets are priced higher relative to earnings, they tend to have lower returns, and vice versa. And today, at least according to CAPE readings, the US has pretty lofty expectations priced in.
Yeah, and I think the point of talking about this is that we want to show that the S&P 500 as it stands today has some issues that need to be addressed. So the question is, how can investors diversify against these two potential issues, over concentration and high valuations? Ryan, do you have any ideas of what to do here?
Yeah, I'd say I do. So do you think about mega cap growth as a upside down triangle, there's a chance it might stand still, but what's more likely to happen, it's likely it's just going to tip over. So that seems like a bet that many people are making. So let's just close our eyes and hope that the triangle doesn't tip over. But our solution to that is pretty simple. So first, if your portfolio is expensive, which would be the case if you have a sizable exposure to the S&P 500, then the solution is actually pretty simple. Just add value. And not just any value, add deep value exposures that actually target the value factor and go up in the cheapest basket of stocks available in the market. And then the next obvious step would be to add an exposure that diversifies value and mega cap growth and has the possibility to add expected returns. And we just believe momentum is the answer there. So what does that end up looking like? Well, the actual weights could vary from person to person. In our model, we recommend investors invest 60% in the S&P 500, 20% in the Alpha Architect US Quantitative Value ETF, ticker QVAL, and then 20% in the Alpha Architect US Quantitative Momentum ETF, ticker QMOM, for the US stock exposure. So why choose our products? Our products consistently get you more value and more momentum exposure than our competitors. So you can think of it like this. If you believe value and momentum are the right solution to diversify away from the US market, we provide you more of that. So this chart shows you that both of our momentum products have a higher momentum score than their peers, and that both of our value products are cheaper than their peers, and significantly so. So the net result is you end up lowering the weighting of your top 10 holdings, which effectively lowers the concentration and diversifies into other names that show interesting factor exposures.
Hopefully this leaves everyone with a lot to think about. But I think our main point is this. If your portfolio is expensive and concentrated, you should address those problems, as we know that historically, it's just not a great place to be. We believe our value and momentum exposures are a great solution for this problem, and potentially the best solution, and allows you to diversify while potentially enhancing returns in the future. Hope you enjoyed this video from me, Jack, and Ryan. We hope you have a wonderful day, and we'll see you next time.